Picture this. You're standing at an online checkout page. Big, bold total at the top, shipping just below, and then the little row of buttons. Pay with card, pay with Apple Pay. And now, in the middle of all of that, a bright, friendly option. Buy now, pay later, 4 interest-free payments. Most people see convenience. Banks see a land grab. If you've ever typed "why banks fear buy now, pay later" into a search bar, what you're really asking is, why does that one little button scare a trillion-dollar industry? Let's walk through that, calmly, because the answer has very little to do with fintech magic and a lot to do with who owns the checkout and who gets to pretend they're the good guy. For decades, banks have sat at the center of your financial life without ever having to shout about it. You get paid, it goes into a bank. You tap your card, that's the bank. You miss a payment, definitely the bank. And the single most profitable product in that universe for a lot of big players is the credit card. On the surface, it looks simple. You swipe, a fee gets taken from the merchant, you pay your bill every month, done. Under the surface, the economics are different. A big chunk of people pay in full every month. Banks call them transactors. Nice to have, but not the profit center. The real money is in the revolvers, the people who carry a balance month after month at interest rates that can sit in the high teens or low 20s. Add in late fees, penalty rates, and the occasional balance transfer, and suddenly that harmless little rectangle of plastic is throwing off returns that most businesses can only dream about. And remember, every one of those purchases also flows through the bank's systems. They can see where you shop, how often, for how much. That transaction data helps them decide who to lend to, what to sell you next, and how risky you really are. For a long time, banks owned both the payment rail and the story. Use our card, get your points, we'll take care of the rest. Then buy now, pay later showed up and quietly started attacking both. Let's strip the buzzwords away for a second. Buy now, pay later is just short-term installment credit, wrapped in modern UX. Instead of, here's a line of credit, go wild and we'll see how much you still owe at the end of the month, it's that $200 purchase, pay $50 now, then $50 every 2 weeks. No interest as long as you pay on time. Under the hood, BNPL companies make money from merchant fees that are often higher than standard interchange, late fees when people miss those easy payments, interest and fees on longer-term plans for bigger purchases, and increasingly, the data that comes with sitting right at checkout. Globally, this has gone from cute little fintech niche to a market projected in the hundreds of billions of dollars of annual volume, with growth still expected through the end of the decade. And it's not random who clicks that button. Regulators and central banks keep finding the same patterns. BNPL use is disproportionately high among younger consumers and people who are more financially stretched, the exact group most vulnerable to overextension and phantom debt they can't easily see in one place. So there's a tension already. Consumers like the clarity of 4 fixed payments. Merchants like the higher conversion and bigger basket sizes. BNPL providers like the volume and fees. And banks see their favorite engine being bypassed. Not because BNPL is evil, because it changes where the power sits. Here's the key idea. Banks don't just fear BNPL as a product, they fear BNPL stealing the checkout and the story. Whoever sits at checkout controls 3 very valuable things. The default choice. Most people click what's in front of them. If Pay in 4 is the giant friendly button and credit card is the small text link, behavior shifts. Second, the data stream. If Klarna or Affirm or any BNPL provider owns that front door, they see the transaction first. They can build their own risk models, loyalty loops, cross-sells, without the bank. Third, the narrative. We help you budget with simple installments is a much cleaner story than we charge 21.99% if you slip up. From a bank's perspective, BNPL at checkout is like someone building a toll booth in front of your toll booth and convincing drivers they're the ones keeping traffic fair. You can see the anxiety in how incumbents respond. At first, BNPL was dismissed as glorified layaway. Then the volume started to add up. E-commerce players saw that having a BNPL option could slash cart abandonment and lift average order value, especially with younger shoppers who hate the idea of credit cards but will happily slice a purchase into 4 payments. That's when the tone changed. Suddenly, BNPL wasn't just cute fintech, it was dangerous, underregulated, and a threat to vulnerable borrowers. Now, to be fair, some of those concerns are real. Because BNPL is so easy to click and often didn't show up clearly on credit reports, you could have someone juggling a few credit cards, a personal loan, and 5 BNPL plans for clothes, electronics, and groceries, and no single lender seeing the full picture. Credit unions and underwriters warn that this kind of hidden liability makes it harder to assess risk and increases the odds of someone quietly getting in over their head. So yes, there is a genuine consumer protection angle here. But that's not the whole story. This is where the incentives get interesting. Whenever a powerful industry starts saying, "We're just worried about consumers," it's worth asking a simple follow-up. And what are you worried about losing? In the last few years, you've seen regulators and credit bureaus start to drag BNPL into the same sunlight as traditional credit. In 2024, the U.S. Consumer Financial Protection Bureau issued an interpretive rule saying many BNPL providers effectively count as card issuers under existing law, which would bring them under certain credit card-style protections and obligations. In 2025, under political pressure and industry lawsuits, that same bureau announced plans to pull back from enforcing that rule, part of a broader rollback of consumer finance regulation. Meanwhile, FICO is rolling out new credit scores, FICO 10 BNPL and similar, that explicitly incorporate BNPL data, so lenders can see those payment plans when deciding whether to give you a car loan or a mortgage. On paper, these moves are all about protecting people, making sure you can dispute bad charges on BNPL like you can on a card, making sure lenders don't hand out new debt without seeing the BNPL stack you're already carrying, making sure irresponsible providers can't hide outside the system forever. In practice, they also remove one of BNPL's biggest competitive advantages, being cheap, lightly regulated, and partially invisible. As BNPL gets treated more like a card, in terms of compliance, capital, reporting, score impact, its cost of doing business rises, margins compress, the Wild West fades. And who's very comfortable living in a world of heavy regulation, giant compliance teams, and detailed credit data? Banks. So when you hear banks, card networks, and their lobbyists push for a level playing field, what they're really saying is, if we have to follow all these rules, we'd like our new competitors to have to follow them too. Some of that is absolutely reasonable. You don't want unregulated loan sharks in your shopping cart. But some of it is also classic defensive strategy. Raise your rivals' costs, shrink their information edge, and pull them onto the field where you're strongest. That's why the BNPL is dangerous narrative is half about genuine risk and half about protecting the old profit pool. There's another tell. If banks truly thought BNPL was evil in principle, they'd refuse to touch it. Instead, what have they done? They've started copying it. Credit issuers quietly rolled out their own Planet or FlexPay options, letting you split a purchase into fixed installments inside your existing card account. Some banks and networks partner with BNPL providers to power white-label installments for merchants. Others experiment and then retreat when the numbers don't justify the effort, preferring to steer customers back to their old faithful products, cards, overdrafts, personal loans. At the same time, big BNPL players are inching closer to looking like banks, launching debit cards that blend Pay Now with Pay Later, building their own consumer apps with savings, shopping, and budgeting baked in, seeking banking licenses or deep partnerships with licensed institutions in the background. Each side is trying to absorb what works from the other, while keeping the most profitable parts of their own model intact. That's not a morality play. It's a negotiation over who sits between you and your money. The part that rarely makes it into the marketing is the psychological game. Credit cards play on abstraction. You don't feel the cost in the moment, you feel it when the statement hits. If you can't pay in full, the pain gets pushed into the future, wrapped in compound interest and minimum payments. BNPL plays on fragmentation. Instead of one big scary number, you see 4 small ones. Instead of "I'm taking on debt," it feels like it's just $50 every 2 weeks. For some people, that actually helps. A finite plan with a clear end date can be less dangerous than a revolving card balance that never seems to shrink. For others, especially if they start stacking multiple plans across different apps, it becomes a different kind of trap. Lots of small obligations that quietly eat into next month's paycheck, leaving no slack when something goes wrong.
Banks understand this psychology very well, so do BNPL providers. The difference is in how they choose to talk about it. Banks have spent decades telling a story of responsible credit, even while profiting most from the customers who struggle.
BNPL companies tell a story of smart budgeting, even while driving more consumption and making their money from fees and merchants who benefit when you spend just a little more. So when you hear, "We're worried about young people," from either side, it's worth remembering, both models can hurt you if you mindlessly click. Both models can be useful tools if you understand how they're trying to make money off you. The real question isn't, is BNPL good and banks bad, or the other way around? It's, do I see the incentives clearly enough that I'm not the product? So where does this leave you, the person actually clicking the button? A few simple principles go further than any hot take. First, treat BNPL as real debt. If you wouldn't take out a small personal loan for the thing you're buying, don't trick yourself into doing it just because the payments are chopped into 4. Clothes, gadgets, impulse purchases, if the only way you can afford them is by slicing them into installments, that's a signal, not a solution. Second, zoom out from the button to the month. Banks would love you to focus on minimum payment due. BNPL would love you to focus on just $40 today. Instead, ask, what does my total committed outflow look like over the next 30 to 60 days, across cards, BNPL, loans, everything? If the answer makes you nervous, that's your real risk, not whether the logo is a bank or a fintech. Third, remember the pattern. Ignore, dismiss, attack, copy, absorb. Every time you see a new financial product, crypto yields, BNPL, whatever comes next, you can watch the same movie play out. Incumbents ignore it, then sneer at it, then warn it will destroy the world, then quietly launch their own version. Understanding that pattern won't make you rich overnight, but it will make you much harder to manipulate. Because now, when a bank says, "We're terrified of this thing for your sake," you can calmly ask, are you terrified or just annoyed that someone else is standing between me and the Pay Now button? And when a BNPL app promises a smarter way to pay, you can calmly ask, smarter for whom? In the long run, banks will adapt, BNPL will mature, regulators will swing back and forth, scores will adjust, the industry will keep fighting over who owns the checkout and the story. You don't have to pick a side in that war, you just have to stop being the battlefield. If you can see the incentives on both sides, you're already ahead of most of the market. If this sharpened how you think, not what you think, this channel is for you. We focus on understanding reality, not selling excitement. Peace be with you.